forget, photography fees earned, it's a revenue account, right?
Okay.
And because it's a revenue account, it'll always be a credit.
Okay.
Because what revenue does is it increases owner's equity.
Okay, so of these, we got, okay, all 7 of these, some of them are gonna be on the left side of the equal sign, some are gonna be on the right side of the equal sign. I guess we're trying to figure out which ones are on the left side. So we got everything.
All
on the
right,
left side.
sure. By the way, 56 has an example, and by the way, accounting isn't necessarily difficult, but it is time consuming. If you do your practice, you should be just fine. You gotta do your practice. So, and by the way, guys, can I get everybody's attention here? So, what you might do is look at page 56, for example, or the example on the board. There'll always be a debit and always be a credit. And in this case, what they did is, let's see, what was the, where's the debit on that thing? So in this case, an asset increased, so you debited it, and a revenue increase, so you credited it. That's why it was done that way. Okay? And these are good questions. Any other questions? All right. Let's do this then. Let's do quick study. 2-3. You find that on page 77. And again, accounting isn't necessarily difficult, but it does require practice. So let's take a look at this. So quick study 2-3. So what this asks you to do, it says identify. So identify whether a debit or credit yields the indicated change for the following accounts. So the first one, let me put up the answers here. So the first one says, what they do is this is quick study. So what it says is, put this here. So what it says is, what we have here is increased store equipment. Now what kind of account is store equipment?
It's
An asset, right?
Yes.
When assets increase, do they debit or credit? Debit. So that'll be the answer. Okay? Everybody okay with that? The next one, let's take B for instance. Increased land. What kind of account is land? Asset. And it increases, so that'll also be a debit. Okay? So you guys want to do this, and I'll put up feedback as we go along. Hey, by the way, guys, if you want a kind of a reference, check out page 56 or the board.
Yeah. Line and building. It would be a debit. Debit, right? Yeah.
By the way, if you want some feedback, now here's the first four.
What page is this on?
Right here, what we're doing here, page 77.
Yeah. Asset. Yeah. Decrease.
Let me put up a few more. So here's some more, here's some more. Oh, okay. Neil, we got a question. All right. Hey, by the way, guys, don't forget, any conversations are going to end up on YouTube. Seriously, so just be careful. No F-bombs. Well, who knows? This guy's got, looks like he's kind of devilish, you never know. Yeah, all right. Okay, you guys doing good? You ready to smack? Okay. All right, so here's some more answers. Yes.
On decrease account receivable, on decrease account receivable, it starts at
Accounts receivable is an asset, assets decrease with credit. All right, you guys doing good? Let's do some more practice. So let's do quick study 4. And that's on the same page. So quick study 4. And here's how it reads. So what it says, now the normal balance is on the side of the increase. So equipment is an asset. It increases with a debit. The normal balance will be a debit. So I'll just put this up here. So here's quick study 2.4. The normal balance is on the side of the increase. Okay.
That makes sense.
What is this?
Yeah, what it's saying is that a normal balance is an asset, normal balance is a debit. Exactly. Revenue always use credit. Sure.
So appointment is debit.
Because it's an, because it says what's the normal balance, right? Now the normal balance is on the side of the increase. And assets increase with the debit.
Oh, there you
Oh, wait.
Let me put up some more answers for you. Here's the first 6. Now, am I moving along too quickly? Does that sound about right? I'll see what questions there are. What's that?
Wages payable.
Anything that has payable will be a liability. Anything that says payable will be a liability. Just anything that is, anything that says payable will be a liability. Anything that says receivable will be an asset. So accounts receivable notes that says.
Oh, okay.
And by the way, if it says payable, it's not an expense, it's a liability.
Okay.
Yes, that's how you do it.
All right, so here's the rest of 2-4. Any questions? Now, how you guys doing? Let me turn on some lights here. Let's go over this normal balance thing just for a minute. This one. All right, so let me just show you something, why that's called a normal balance. So I'm going to go ahead, thank you, I'm sure I'm stepping on a toe here. All right, let me move this over here. All right, move this here. All right, so, I think I'll get past you here. Make sure I don't do it. All right. So, here's the thing about a normal balance. So you have assets equal liability plus owner's equity. And here you have cash, and here you have accounts payable, okay? And here you have, let's just, here you have $100 debit, right? Does that sound about right? And it's on the side of the, and so here you have a $150 accounts payable. So this is an asset, a normal balance of a debit, right? This is a credit, normal balance, this is a liability, normal balance for a credit, right? So they send a check. So this has $150. Now this is a $50 credit, 150, this is 0. So for cash, this is a not normal balance. Not normal balances are usually bad. In this case, you bounced a check. Okay? Yeah. So here's a normal balance, and in most cases, a not normal balance is a temporary problem that you got to fix. And this particular not normal balance is a credit cash balance. Credit cash balance means you wrote a check for too much. You wrote a check for more money than you had in the bank. So this is the, I'll put N here for normal. I'll put N here for normal. So the normal balance for a liability is a credit. The normal balance for an asset is a debit. This is a not normal balance. It represents a NSF, non-sufficient funds. So a not normal balance is normally is bad. Something you got to fix. And that's where this normal balance thing comes in. You guys doing good? Mm-hmm. All right. Let's do 2-5. Now, and you guys, this is kind of, and again, accounting isn't necessarily difficult, but it does require practice. So just keep practicing it and you'll shine. Okay? So let's do quick study 5. Let me see, that's, yeah. Let's do quick study 5. It's just the next one down. Here's how it reads. So what it says is, on this thing, what it says is, indicate whether a debit or credit decreases the normal balance of each of the following accounts. So does a debit or credit decrease the normal balance? I'll put this here. I'll make the board easier to read.
So in the first one, the patients are dead. Yeah.
Are you guys read okay with that? That's too dark. Good. Good. All right.
Wouldn't be an increase.
Too dark? That's regular revenue. Yeah. And then G is the So, and by the way, this is salary. Your revenue is revenue is the line item. So when you earn it, it goes into revenue, that's 100% of the account. If you receive that's why it's like, that's the honor. It was your they'll tell you it's an advance payment, or they'll tell you.
Credit
Interest.
Yeah, maybe not just put that on this part. So here's the first four, if you want some feedback. First of all, yeah. And here's the deal. No, expenses are always fixed debits, revenues are always fixed debits, with a few exceptions. And let me show you the exceptions. Yeah. Now, there will be exceptions. You guys doing good? All right, peachy keen? You guys doing good? Ready to see answers? All right, it looks like people are ready for some answers. How's that look? Let me see what questions there are. Doing good? All right. All right, if you guys, you got a question. All right, so let's do this. Let's do exercise 2-4, page 78. So exercise 2-4, page 78. And again, with accounting, that's a matter of practice. Practice, practice, practice. Okay? So here's exercise 2-4. Page 78. Here it is. All right. So what this says, it says identify the normal balance debit, or what's it? I'm sorry, it's exercise 2-4, not what's that 2-4. All right. Here's exercise 2-4. So what exercise 2-4 says is, let's see, let me fold this in half, get that arm is kind of flopping there. Here's exercise 2-4. So what it says is, for each of the following, identify the type of account, asset, liabilities, equity, revenue, or expense. Identify the normal balance of the account, and any either debit or credit to identify the kind of entry that would increase it. So let me put up the first one to show you what they want here. So here's exercise 2-4. So the first one is fees earned. So fees earned is a revenue account. It has a normal balance of a credit, and it will increase with a credit. Okay? And again, this is, yeah.
Shouldn't normal balance and increase be the same all the time?
Exactly, and that's kind of like a trick question. The point they're making is the normal balance is in the side of the increase, because when you see the answers, the last two columns will be identical. But they're just trying to make that point. All right, so we're doing problem two.
So what normal balance people? What's normal balance people would be? What liability?
I'm just checking, you guys don't do? You'll have a question anytime.
Oh, okay.
So which one are you looking at?
No table of
D,
liability.
owner's capital, yeah. When they say owner's capital, they're talking about this account here. Well, the capital account is under owner's equity. And what it is, actually, let me give you a pretty good answer here. Here's the deal. This is a permanent account. This is their all temporary. Now, at the end of the accounting equation, all of these will be clashed into this. And so, this 10,000 will be decreased by 20, increased by whatever the, well, this would be, what it would be, 1,750, decreased by 100, decreased by 600, and that'll give you the ending balance. Okay. Yeah, because when you buy an insurance policy, you own those rights for, in this case, the year. And that's the asset. So when you buy an insurance policy, you own that insurance policy. Okay, let me give you a good answer. Now, what happens on this thing is, prepaid, and the name of that is prepaid insurance, right? And so what happens is, when they buy it, they own a $1,200 policy. Then, it's good for a year. So divided by 12, every year, every month, $1,200 expires. That's the cost to do business for that month. So it starts out at 1,200, decreases by 100, decreases to 1,100. This decrease shows up as but sure, when you buy the policy, you own the policy. It's an asset. You guys doing good? Yo, if you got a question, always on be sure to yell if you got a question, right? They're trying to make the point. Okay. Yeah. This is doing so. Sometimes it will be a trick.
If it was a decrease
Sure, when you buy an insurance policy, you own an insurance policy, and that's an asset.
Oh, no,
The only one that confuses me is expenses, because basically how I keep track of things, this side of the equation is going to be debit, this side of the equation is going to be credit, but expenses is minus. Is that one also going to be debit then? Because
And the reason is over here, so let me show you, so expenses, now what they do is an expense, like here's expenses, all right, rent expense, here's expenses, so rent expense, insurance expense. So what it is it's the cost of doing business, and expenses generate revenue. But these are the cost of doing business.
Okay, so pretty much debit, expenses. Everything.
That's what it's called.
Withdrawals are debit as well.
In fact, I'm gonna put this up on the board right now. So on that one, kind of a mnemonic device. You got wrong.
That's why I'm waiting.
Equals CRL. So assets, withdrawals, and expenses are all there. So remember, regular, So I equals C R L.
Capital is the same as an
Owner's
owner's
withdrawal, that's the debit credit.
Now, to be clear, the capital is a type of.
Well, that's
a debit.
It's where you put and invest. So the capital is one of those. There's capital, withdrawal, revenue, expenses, all four of those are equity. And withdrawal, it's a negative equity.
Oh, that's my problem. I put a plus sign.
It's a negative equity.
That makes sense now.
All right. You guys, here's the thing, thank you. So here's some feedback, and Neil, if you got a question. Let me check my number.
Yeah, like I said, we're gonna make a problem.
That'll do it. Yeah. And which was it's an equity, it's negative.
Oh, all right.
Right.
Any other questions?
Trying to help you with yours.
Yeah, so it's revenue that is on, it's like, you get like, like in this case, you got the advance. $600.
Increase in the debit credit, increase your credit. Credit.
Warning is quite big. Skip.
Are you ready for some more answers? All right. So here's some more answers. Am I moving too quickly here? Okay. Now notice the last two columns are identical. And you wanted to make the point that the normal balance is on the side of the increase. Now, by the way, sometimes it's practice as it is here. Sometimes it is a trick question. But this is not the trick question. This is just the practice. All right, sounds good. And I'll see what questions there are. Let me turn this thing while I'm in the business.
Owner's equity?
Whatever
Oh,
side.
under withdrawal.
So if it's an asset, it'll always be a debit. The liability will always be a credit. All right. You guys, let me do a couple more things before we take our break. So is everybody, what questions are there on this? Yeah.
So I put prepaid insurance as a liability, not an asset.
You know when you buy an insurance policy, you own it, that's an asset.
Okay, so that because it's prepaid, it kind of.
Yep, and all prepaids are that way. All right, you guys, I'm going to run over two things before we take our break, just kind of. So here's a mnemonic device, okay? And I'll put it here. So the mnemonic device is AWE equals CRL, okay? So these are going to increase with the debit. Assets, withdrawal, and expenses. Okay, so all of those increase with the debit. And don't forget, DR is abbreviation for debit, right? Now, all of these increase with the credit. So you have capital, revenue, and liability. And so if you want a mnemonic device, that's one. So A equals CRL. Okay? Just a mnemonic device. Now, one more thing. All of us kind of have to struggle with the fact, credit seems good. Therefore, debit should be like bad, right? Okay? Well, here's how I think it came about. Basically, right-handed entries are generally good, but it's the right-handedness that makes it good. So for instance, here's the bank. Okay, so on the bank's books, you have assets equals liability plus owner's equity, right? Under assets, you have cash. And under liabilities, you have accounts payable. So if you make a deposit in a bank, let's say you deposit $100. Well, they'll debit cash for $100, and they'll credit your account for $100. And your account on the bank's books are a liability, because it's your money, it's not their money. So your account is a liability account. So when it increases, they credit your account. Now, I think this is why we use the word credit in the way that we do, right? And it's because right-handed entries, as a general rule, are good for the customer. And so I think we went right-handed entries, good, and that's why we say we give people credit. But all it means is it's a right-handed entry we're talking about. And I think that's where the word giving somebody credit came about. Another example, suppose instead of being a bank, this is a store. So if you go into the store, buy $100 worth of jelly beans, okay, and sales is the name of the revenue account for a store. You buy $100 worth of jelly beans, okay, store, candy store. So what happens on that thing, and then you say charge it. So here you bought $100 worth of jelly beans. So what they'll do is they will debit accounts receivable, because you're going to send them the money, and you credit the revenue account, and sales is the name of revenue account for a store. Then, when you send them the $100, they'll credit your account and debit cash. So here, giving you credit means your debt to them decreases. So I think this is why we use the word credit the way we do, because right-handed entries are generally good for the consumer. And that's why I think we give people credit, because we could easily have said, we're giving you a right-handed entry. I mean, it would have worked, right? Except credit's a little better. Does that make sense? All right, you guys, let's take our break. Now, could you keep an eye on your watches, because I'll really try to start in 10 minutes, okay?